welcome to Investors Hangout. This weekly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, are you wondering if it is better to choose a fund with a concentrated portfolio or the one with a widely diversified portfolio? After all, we've often heard that one shouldn't put all their eggs in the same basket, isn't it? So, should one diversify or not? Is a concentrated portfolio better than a diversified one? We'll talk about that in great detail in today's episode. Keep watching.
SEBI went about classifying mutual fund, and mutual funds were permitted to launch a certain set of funds. Before that, any mutual fund company could have launched any kind of equity fund. They could devise, they could think of an idea and they could launch a fund. That is the time when many fund companies went about launching a focused fund. And when this classification came about, then most fund companies demanded that there is this focused fund that they have launched, and it may not really merge in, because SEBI permitted a large cap fund, a mid cap fund, a small cap fund, and a multi cap fund, a fund which can invest anywhere, and a flexi cap fund where the fund manager will have flexibility to invest anywhere. So they demanded that they need a separate category for focused fund. This is a fund which permits a fund manager to take a big bet on a certain set of stock, whether it be large, mid or small, the kind of stock where he has conviction, and there could be a potential reward for taking such a position. So this is how the focused fund came into being. So focused fund can also be diversified, and many a times a diversified fund can also be focused if it is small. If there is a 300 crore diversified equity fund, nothing prohibits it to invest in 25 stocks, and it can well look like a focused fund. Compared to a diversified equity fund, which sometimes, often tends to be, 50, 60 stocks, focused fund don't exceed, by the very design, they are not supposed to exceed 30 stocks. And that also depends. It could be more concentrated. And that also depends on the size. Focused fund can also be pretty diverse in terms of large cap, mid cap, small cap. It can take few positions in small caps and mid caps as well. By the very design, they can turn out to be more volatile, but many a times volatility or return, we would think that they tend to give more return simply because they have assumed greater risk of concentration. But looking at the numbers, it's entirely a matter of how one fund manager is designing the portfolio. Some of the focused funds are more volatile, they fall more in a falling market compared to the diversified equity fund, the flexi cap or the multi cap of the same fund family. But I have also come across funds which don't fall as much. Sometimes the focused fund tend to be more stable. And also the jury is still out that whether over a period of time they will deliver more return, because there are examples of both kinds. There are focused funds which have underperformed their diversified equity, and there are funds which have beaten the diversified equity fund by a wide margin. So it's a mixed bag there. But the whole assumption is that here is a fund manager who is allowed to bet on his conviction in the kind of stocks in adequate quantity or in a meaningful scale, invest in a certain set of stocks in which he believes more, and that should translate into superior performance for the investors. A concentrated portfolio means that there is a potentially higher return possible if the fund manager goes right with his bets, then simply because he has meaningful allocation, 5%, 7%, 10% position in a single stock, that will translate. So there is a huge reward for being right. The second thing is that, if manager goes wrong, there is just the other side of it. If you go wrong, so there is a severe penalty as well. When you have 10% position and you take a big hit. So this is what comes naturally for concentration. Then there is a possibility of a winner's curse. If a fund manager succeeds with his big bets in a focused fund, then he will get so much more money. And if that strategy was in mid cap and small cap, then if the fund manager starts getting more money, replicating that strategy might get difficult. And this is a problem which is there, which is valid for most funds. The winner's curse. If a fund does well, more investors put money, it becomes so big that it becomes difficult for the fund manager to repeat the strategy. The key difference is that focused funds will be more volatile, and one should expect more return, but the more return may not be guaranteed. Diversified fund might turn out to be more stable. There isn't as severe a penalty for going wrong. And we have examples of both kinds. There is a very successful diversified fund which has 2% position in about 70 stocks. And then there is also a very successful focused fund which has 10 positions in which are over 7-8%. So the heart of the matter is that the fund should be good. The fund manager should have gone right with his fund management. Focused or diversified, of course, if I just look at the downside, diversified has lower downside because the price of going wrong, you don't have to pay a heavy price. But in case of focused fund, the price could be very steep. Comparing the return of a focused fund and a diversified equity fund, the flexi cap or the multi cap, so to say, the difference is not meaningful enough. Over most time period, 1 year, 3 year, 5 year, when I look at these returns, the difference in return is not exceeding 0.5%, which is not meaningful. And that too, we are looking at these returns, the trailing returns, after in a declining phase. So that is where, quite understandably, the focused fund would have lower return, and they have lower return. And over longer time period, they have marginally higher return, 0.5% more. So that also is quite understandable that there is a modest reward for taking a concentrated bet in a fund. So with if I have to summarize, focused fund, they can potentially give you more return, but they come with greater volatility. There could be a greater downside risk. Diversified fund, they tend to be more stable, and return, the jury is still out. Any of the two kind of fund can actually do well. Don't get focused on focused fund. Get focused on choosing a good fund, a fund which does well in a falling market, a fund which does well in a rising market. And if you have chosen one such fund, focused or diversified, it doesn't matter.
Well, with that, it's a wrap. Keep watching this space for more information. If you like the show, do subscribe to our YouTube channel. Keep watching. Take care. Bye for now.